December 2025. Right now, while you're reading this, something is terribly wrong. And the people who should be warning you are staying silent. Not because they don't know, but because they don't want to admit what the numbers are screaming. I'm going to show you 14 specific warning signs. The exact same signs that appeared before the 2008 financial crisis. The same signs that flashed before the dot-com crash in 2000. The same signs that showed up right before the Great Depression in 1929. And right now, every single one of them is flashing red. This isn't about fear or panic. This is about pattern recognition. And once you see this pattern, you can't unsee it. A major financial crash is coming. Not someday far in the future. Not in a decade. But within the next 12 to 24 months. Somewhere between mid-2026 and late 2027. The machine is already in motion. The countdown has already started. And here's the truth that nobody wants to say out loud. Nothing can stop it now. The only thing that can be controlled is the timing. You have roughly 18 months. 18 months to protect your money. 18 months to get out of dangerous investments. 18 months to prepare for the biggest transfer of wealth since 2008. Some people will lose everything. Others will come out stronger than ever. The difference won't be luck. It will be preparation. Let me be clear about something. This isn't a guess. This isn't a theory. This is what happens when you look at the actual data. When you study the math. When you understand the pattern that has played out over and over for the last 100 years. Right now, the U.S. economy is in the final chapter of the longest economic expansion in modern history. We've been in a bull market since March 2009. That's 16 years. Think about that. Normally, these cycles last 5 to 7 years. The longest one before this was 10 years in the 1990s, and it ended with the dot-com crash. We're now 6 years past the average. But crashes don't happen just because something is old. They happen because of specific conditions. Mathematical conditions that create a house of cards. And every major crash follows the same 4 stages. Stage 1, everyone gets excited, and prices go up. Stage 2, warning signs start flashing, but everyone ignores them. Stage 3, something breaks and exposes how fragile everything really is. Stage 4, everything falls apart as people panic and sell, which makes prices fall more, which makes more people panic. We are in stage 2 right now. The warnings are everywhere. But just like in 1929, just like in 2000, just like in 2008, people are ignoring them. Let me show you exactly what I mean. Go back to 1929. The Roaring Twenties. Everything seemed perfect. The stock market had gone up 400% in less than 10 years. New technology was everywhere. Cars, radios, electricity. Everyone was making money. Everyone was buying stocks. And more people were borrowing money to buy even more stocks. This borrowing, called margin debt, reached 12% of the entire economy. But underneath all this success, things were breaking. Farm prices had been crashing since 1926. People were drowning in debt. Something called the yield curve, which is a reliable warning signal, had inverted in 1928. Real estate in Florida had already crashed in 1926. Banks were making riskier and riskier loans. But the experts said everything was fine. The most famous economist in America, Irving Fisher, said in September 1929 that stock prices had reached a permanently high plateau. 1 month later, October 24, 1929, Black Thursday hit. The market crashed 11% in one day. 5 days later, on Black Tuesday, it fell another 12%. Over the next 3 years, stocks kept falling. By 1932, the market was down 89%. $30 billion vanished. 9,000 banks failed. 1 out of every 4 people lost their jobs. Half of all factories shut down. The warning signs were there. The experts ignored them. Millions of people lost everything because they believed this time was different. Now jump forward to the year 2000. The dot-com boom. The internet was going to change everything. Companies that had never made a single dollar of profit were worth billions. The Nasdaq stock index went from 1,000 in 1995 to over 5,000 by March 2000. People were quitting their jobs to trade stocks full-time. Everyone said the old rules didn't apply anymore. This was a new economy. But the warning signs were there. The yield curve inverted. Corporate debt hit record levels. That dangerous margin debt reached 2.7% of the economy, the highest since 1929. Technology stocks were trading at 100 times their earnings. Some had no earnings at all. The Federal Reserve started raising interest rates, but Wall Street analysts said none of it mattered. Traditional ways of valuing companies were outdated, they said. Then, on March 10, 2000, the Nasdaq peaked at 5,048. By October 2002, it had fallen 78%. $5 trillion in value disappeared. People's retirement accounts were cut in half. Hundreds of companies went bankrupt. The warning signs were there. The experts ignored them. Millions lost fortunes because they believed this time was different. Now to 2008. The housing boom. Everyone believed real estate only goes up. Home prices doubled between 2000 and 2006. Buying houses became the way to get rich. People were getting mortgages with no down payment, no proof of income, no proof of assets. Banks loved this because they didn't keep the mortgages. They made the loans and immediately sold them to big investment banks, who bundled thousands of them together into complicated securities. Everyone made money on fees. But by 2006, the warning signs appeared. Housing construction peaked and started falling. Mortgage defaults started rising in early 2007. The yield curve had inverted in 2006. Consumer debt was at record highs. Major banks were leveraged 30-1, meaning if they lost just 3%, they would be wiped out. Ben Bernanke, the head of the Federal Reserve, said in 2007 that the subprime mortgage problems would be contained. The Treasury Secretary said the financial system was sound. They were completely wrong. On September 15, 2008, Lehman Brothers, a 158-year-old bank, collapsed. Credit markets froze. The stock market fell 57%. $11 trillion of wealth was destroyed. Unemployment hit 10%. 9 million jobs disappeared. The warning signs were there. The experts dismissed them. Millions lost everything. 3 crashes, 3 different decades. But look at the pattern. The same pattern every single time. Prices too high. Borrowing too easy. Debt too high. Warning signals flashing. Experts saying this time is different. Then collapse. Now look at today, December 2025. Let me show you the numbers. The total U.S. stock market is worth about $60 trillion. The U.S. economy produces about $26 trillion per year. That means stocks are valued at 230% of what the economy actually produces. This is called the Buffett indicator. The normal average is 100%. Before the dot-com crash, it peaked at 148%. Before 2008, it peaked at 105%. Today, it's at 230%. This is the most overvalued stock market in recorded history. There's another measure called the Shiller-Cape ratio. It looks at stock prices compared to earnings over 10 years. Right now, it's at 39. The normal average is 17. Before the dot-com crash, it peaked at 44. Before 2008, it peaked at 27. We're at 39 right now. Stocks are trading at more than twice what they should be worth. Remember that dangerous margin debt I mentioned? The borrowing people use to buy more stocks? It's at $800 billion right now. That's about 3% of the economy. There have only been 3 other times it got this high: 1929, 2000, and 2007. Every single time it came right before a massive crash. Here's why that's so dangerous. When stocks start falling, brokers force people to sell to pay back their loans. This forced selling pushes prices lower. Lower prices trigger more forced selling. It becomes a death spiral that feeds on itself. Corporate debt has climbed to $14 trillion. That's almost 50% of the entire economy. The normal average is around 35%. Here's the problem. Most of this debt was borrowed between 2020 and 2021 when interest rates were 2% or 3%. Now those loans are expiring, and companies have to borrow again at 5 or 6%. That means their interest payments are doubling or tripling. A company that was paying $60 million a year in interest now has to pay $180 million. That's an extra $120 million coming straight out of their profits. When profits fall, stock prices have to fall. But they haven't adjusted yet. Commercial real estate is in serious trouble. Office buildings are sitting 20 to 30% empty. Property values have fallen 40 to 60% from their 2021 peaks. A building worth $200 million in 2021 might only be worth $100 million today. But it still has a $150 million mortgage on it. That building is underwater by $50 million. And here's the crisis. $1.5 trillion in commercial real estate loans come due between now and 2027. When these loans expire, the borrowers have to refinance or pay them back. Banks won't refinance properties that are worth less than the loan. That means defaults, mass defaults. And those defaults will hit regional banks hard. Regional banks are still in serious danger despite the bailouts in 2023. From March to May 2023, 3 major banks collapsed: Silicon Valley Bank, Signature Bank, and First Republic. They were only stopped because the Federal Reserve stepped in with emergency money. But the underlying problems were never fixed. Regional banks are holding about $1.3 trillion in commercial real estate loans that are going bad. When these losses hit, bank capital will be wiped out. That triggers more bank failures, more bank runs. This is exactly what happened in 2008. Consumer debt is now above $18 trillion. Credit card debt alone is over $1.2 trillion, and people are paying an average of 22% interest. Auto loan debt is over $1.6 trillion. Student loan debt is around $1.77 trillion, and people are falling behind on payments across every category. Credit card delinquencies have jumped from 2.1% in 2021 to over 3.2% by late 2025. When people are buried in debt and can't make payments, lenders stop lending and consumers stop spending. Both push the economy toward recession. The personal savings rate has collapsed. During COVID, when the government was sending out stimulus checks, Americans were saving 16% of their income. Now it's down to about 4%. The normal average is 9%. American households have no cushion, no emergency fund. When layoffs start, people have nothing to fall back on. They immediately fall behind on bills, default on loans, and stop spending. This accelerates the recession dramatically. Unemployment has quietly been rising. It went from 3.4% in early 2023 to around 4.5% by late 2025. That's a 1.1 percentage point increase. There's something called the SOM rule. It states that when unemployment rises 0.5 percentage points from its lowest point, a recession has already begun. That threshold was crossed months ago. The SOM rule has predicted every recession since 1970 with 0 false alarms. We're not heading into a recession. We're already in the early stages of one. Manufacturing has been in contraction for most of the past 2 years. There's an index that tracks this, and it's been below 50 for most months since early 2023. When manufacturing contracts, broader recessions usually follow within 6 to 12 months. This indicator is telling you the recession is already here. The index of leading economic indicators has declined for over 20 consecutive months through late 2025. This is the longest consecutive decline since 2007-2008. This index is specifically designed to predict recessions 6 to 12 months in advance. 20 straight months of decline is screaming that a recession is coming. Yet the stock market is still near all-time highs. The Federal Reserve is completely trapped. They raised interest rates from 0 to 5.5% to fight inflation. They've cut back to around 4.5%, by late 2025. If they cut rates too fast, inflation comes roaring back. If they keep rates high, they trigger the recession that's building underneath the surface. There's no path that avoids pain. The Fed isn't preventing the crash, they're just managing when it happens. Geopolitical risk is still elevated. Tensions with China over Taiwan, war in Ukraine, conflicts in the Middle East. Any of these could explode into a shock that ripples through the financial system. In a system that's over-leveraged and overvalued, any shock can be the trigger. The specific trigger doesn't actually matter. The system is so fragile that something will break it. These 14 indicators aren't predictions. They're current facts. They're happening right now, and all 14 are flashing red at the same time. Based on historical patterns, here's how this will likely unfold. Through the first quarter of 2026, markets stay high. People stay optimistic, even though things are weakening underneath. Companies start missing their earnings targets. Defaults start rising in commercial real estate and corporate debt. By the second quarter of 2026, the stress becomes visible. A trigger event happens. This could be a major company going bankrupt, a bank failure, a geopolitical crisis, or something in the derivatives market blowing up. Credit markets tighten up. Stock prices fall 15 to 20%. Forced selling begins. By the third quarter of 2026, the cascade accelerates. The S&P 500 falls another 20 to 25%. We're now down 35 to 45% from the peak. Hedge funds blow up. Regular investors panic and sell. Unemployment spikes toward 7%. Consumer spending collapses. By the fourth quarter of 2026, we reach the bottom. The S&P 500 has fallen to between 2,700 and 3,500. That's a decline of 50 to 60%. Trillions of dollars in wealth have been destroyed. Unemployment peaks between 8% and 9%. The Federal Reserve has cut rates back to zero and started printing money again. The crash has run its course. In 2027, recovery slowly begins. The smart investors who protected their money make extraordinary returns buying at the bottom. But the majority who ignored the warnings and sold near the bottom never recover. Their retirement plans are destroyed. This is not a guess. This is mathematics. The S&P 500 is trading at 6,900 right now. The historical average CAPE ratio is 17. The current ratio is 39. To return to the historical average, stock prices must fall 56%, from 6,900 to approximately 3,000. Valuations always return to the average, always, without exception. The Buffett indicator is at 230% of GDP. The historical average is 100%. To return to average, the market cap must fall 57%, from roughly $60 trillion to $26 trillion. Corporate debt service costs are exploding as cheap debt gets refinanced at triple the interest rate. This represents hundreds of billions in additional annual interest expenses. That money has to come from somewhere. It comes from earnings. Lower earnings mean lower stock prices. Commercial real estate loans totaling $1.5 trillion are maturing over the next 24 months. Buildings are worth 40 to 60% less than what's owed on them. Expected losses exceed $600 billion. Banks will either face insolvency or require government bailouts. This isn't speculation. This is simple arithmetic. The debt is real. The interest rates are real. The losses are coming. The crash begins within 12 to 18 months. By late 2026, the bottom is reached. By early 2027, recovery begins. But the damage to unprepared people will be permanent. The difference between those who get destroyed and those who survive isn't luck. It isn't intelligence. It's preparation. It's recognizing the pattern before it completes. You have roughly 18 months. Think back to January 2008. The S&P 500 was at 1,400. Smart investors who understood what was coming reduced their stock holdings, raised cash, moved into treasury bonds and gold. By March 2009, the market hit 680, down 51%. The people who prepared in early 2008 preserved their capital. Then they bought at the bottom and made fortunes. The people who believed everything was fine lost half their wealth. If someone had come to you in January 2008 and told you the crash was 9 months away, would you have listened? Would you have acted? You're being told right now that the crash is 12 to 18 months away. The indicators are clearer than they were in 2008. The valuations are more extreme. The debt levels are higher. The risks are greater. The crash is coming with mathematical certainty. The same 14 indicators that predicted every crash since 1929 are flashing red simultaneously. The valuations are unsustainable. The debt can't be paid. The system is over-leveraged. When it breaks, the unwind will be violent, fast, and completely unforgiving. You have 18 months to prepare, 18 months to reduce your risk, 18 months to build cash reserves, 18 months before the largest transfer of wealth since 2008 separates the prepared from the unprepared. The pattern is crystal clear. The timeline is set. The crash is inevitable. The only question left is whether you'll be ready when it happens. If this showed you the 14 warning signs, if you understand why current valuations are mathematically impossible to sustain, if you see the historical pattern repeating right in front of your eyes, then act now. You have 18 months. The window is closing. This is not financial advice. This is historical research showing a pattern that has repeated for over a century. And it's repeating once again, right now. Understanding the pattern is the first step to surviving what's coming.